Kevin joins us this morning. He is now a distinguished visiting fellow at the Hoover Institution. And, Kevin, we were talking about this off camera, just the idea of the headline itself. The U.S. needs an economic regime change over a picture of Jay Powell. It sounds like it's putting you in the same camp with Elizabeth Warren, that you think Jay Powell should step aside. That's not what you're calling for here.
No, we've got a team on the field, and we need the team on the field to be successful. We have one economy, one country in a time of huge stress. All I'm trying to suggest in my piece yesterday and this morning is the economic policies that have put us here have shown the economy is weaker. Credit is going to contract because of free money that was practiced for a decade that they doubled down on just a couple of years ago. So all these problems that you talk about every morning about panics at the banks and distress and bailouts, first, they remind me uncomfortably of the 2008 financial crisis. Those are a sign of bad economic policies for more than a decade. So the regime change that we need is a change in economic policy, a change in regulatory policy, a change in fiscal policy, and probably most importantly is a change in monetary policy that created all these disturbances that we're seeing today.
And the change being that we should not be at zero interest rates, that should be a thing of the past?
Yeah, so nothing's more expensive than free money, and free money causes a huge amount of complacency in markets, among banks, among regulators, leads to misallocations of capital from where the money should be going to the hottest, least productive, riskiest thing. We're starting to pay the price for it. I'd say, they now find themselves in a crisis. What should they do about it? As they sit down at the FOMC tomorrow, I think they need to call a big timeout. A big timeout. They've been providing forward guidance in these dots now for a decade. I thought it was a bad idea a decade ago. I think it's a worse idea today. What Jay should do tomorrow would be make whatever decision he's going to make, presumably raising rates a quarter. And when these reporters ask him what should he do next, he should say, I don't know. He should say these forecasts really don't mean anything at all. There's, even in normal times, very little value of these short-term forecasts. I think it confuses markets. It constrains their decision-making. And when you really push and ask yourself, why did the Fed make such a big mistake, keeping interest rates at zero through 2021 when the economy was booming? Why were they so slow to raise rates even a year ago? Their first move was a quarter basis point. When inflation was 8% and the economy was strong, it was because they had tied their own hands through these dots and through talking too much. The central bank needs to be a still and steady point in a turbulent world. If they're not, they find themselves doing these weekend bailouts.
Yeah, and Andrew's got a question, but just very quickly, that basically the idea that they are tying their own hands by doing this, they're not data dependent, which they say all the time they're data dependent, but they're less able to be data dependent when they have these points that are out there.
I think that's right. They're constrained because none of us want to admit that we were wrong. So we say what's going to happen, markets price it, and when the facts change, we need to change. Instead, we think that somehow squanders our credibility. I think the other piece, though, that you bring up is they do keep talking about data dependence. I think there are only two problems with that, Becky. The data and the dependence. The problem with the data is the only place the economy was strong in the first couple of months of this year was in the government data. The economy was not strengthening according to everything I see and touch. The economy was continuing to weaken a bit week over week, month over month, but the government data said otherwise. So the Fed flip-flopped. They came into the year saying inflation's under control, the economy's weakening. And they got a couple of monthly prints from the Bureau of Labor Statistics, the Department of Commerce. And they said, oh, no, the economy's strengthening. We'll have to do more. And it was in the Senate Banking Committee when Chairman Powell said, I might have to raise at 50 basis points at my next meeting. The economy's hotter. The terminal rate might well be 6%. The thing's broke. Stop listening to this government data. Stop relying on it and be steadier and call it the way you see it every 6 weeks when you meet.